The book Capital Allocators by Ted Seiss is for a very specific type of audience. When I first picked up the book, I was under the impression that it will actually go over strategies and techniques of some of the best money managers in the world, because after all, the title was Capital Allocators, how the world's elite money managers lead and invest. If I'm being completely honest, I was a little disappointed while reading this book at first, but not after I finished it. Now that I've had the time to reflect on the lessons of this book, it's opened up a new perspective on how I view asset management, and it's given me a new angle to think about my own investments. Now, this book touches on some of the most important skills the world's best and most elite money managers and capital allocators need to possess in order to succeed in this industry. Because let's face it, collectively, these people are managing several trillions of dollars worth of capital, and that's not an easy task. Now, Capital Allocators is actually a podcast which was started by Ted Seiss in 2017, and it's been downloaded over 4 million times. And this podcast, the purpose of this was to interview the top capital allocators in the world. And this book is a combination of all podcasts on paper. Now, let's start with the most important yet simple question. Who are capital allocators? Now, capital allocators are not your average individual investors or hedge fund managers. These are not money managers. These are, in fact, the folks that sit at the top of the food chain when it comes to capital. We're talking large institutional investors, endowment funds. Think about Harvard, Yale, Princeton. We're talking sovereign funds, large pension funds, trust funds. These are institutional investors known as chief investment officers, or called capital allocators as stated in this book. Now, the subtle difference here is that you and I are making decisions where our capital needs to be invested, right? I mean, we're trying to make decisions on whether to invest in the stock market or real estate, or whether to invest in the S&P 500 or NASDAQ or Apple or Tesla stock. But capital allocators don't make those decisions. Instead, they decide who the capital needs to go to, not where, to further invest for the organizations that they represent. Now, while you and I are managing a portfolio of personal assets like stocks and bonds and cash and real estate, capital allocators manage a portfolio of money managers. That's a crazy concept, and this is a whole different game of diversification. Now, the book precisely goes over the strategies and techniques needed to find the best money managers in the business, sort of like finding a needle in the haystack. Because there was a study done by NEPC, and the amount of active fund managers and money managers that we have right now in the US are over 34,250 between US and foreign international equities, fixed income, balanced strategies, hedge funds, venture capital, real estate, and infrastructure. So that is a very large investable universe of funds and fund managers. So the capital allocators sure have their work cut out for them. Now, this book is broken down into 2 parts. First, the investment toolkit, which goes over the 5 strategies needed by capital allocators to find the best money managers. Second, this part focuses on the investment framework, which explains the whole process of capital allocators once they have found the money managers, how they deploy capital. But before we get there, first let's talk about active versus passive investing. Now, while the book generally agrees that the case for passive investing through low-cost indexing has been bulletproof in theory, it actually argues that the future is not that bright. It says that when money managers look out for the next decade, they believe that the 60-40 stock and bond portfolio will not do the trick. With the S&P 500's expected earnings growth at around 6% per year and a dividend yield of about 2%, and the treasury yield hovering around 2 to 3% depending on when you're watching this video, the long-term expected annual rate of return of a 60-40 stock bond portfolio is expected to yield under 5% per year, which is a lot lower than the spending and liquidity needs of these large institutions and capital allocators. And finally, this book states that passive investing is poorly positioned to meet the spending needs of these institutions, and the goal of active management is to meet their liquidity and their spending needs. So to find the best money managers who can manage assets actively, capital allocators start with the interviewing process. Now, the interview process is the core interaction in the investment process because it is a way for the capital allocator to learn everything about the money manager. And think of this as we do with dating. And that's because capital allocators are looking to develop a strong long-term relationship with the money manager. And they want to know everything about them. And when I mean everything, I literally mean everything, because investing isn't just about numbers and math. It's a lot about emotional intelligence and being able to identify behavioral patterns. And so Ted shares 5 tips for interviewing effectively, starting with defining the purpose of the interview. What are you looking to get out of the interview? Number 2, preparing in a balanced way. So don't over prepare where you come off as a know-it-all, and don't under prepare either where you're not asking thoughtful questions, but instead be balanced in your preparation. Set the stage and find common ground by asking thoughtful yet powerful questions, and remember that less is more while expressing humility and curiosity. Tip number 4 is perhaps the most important, and that is listen actively. Start with the what, the how, and the why, and these open-ended questions can lead to more thoughtful conversations and allow for more perspective. And finally, receive feedback from peers and colleagues and continue to improve on your interview skills. Next, after the interview process, the capital allocators move over to the decision making. Now, when it comes to decision making as a capital allocator, it can get overwhelming because, again, we talked about how there are so many opportunities, so many money managers to choose from. It's not an easy task. And the author mentions that we as humans are inherently wired to make bad decisions. And even in the book Thinking Fast and Slow by Daniel, he talks about how most decisions we make are based on instinctive reactions, our system 1 level thinking. And occasionally we do shift to system level 2 thinking where we carefully process the information, but most of the time we make decisions on an impulse. Now, in order to avoid that and make better decisions, a capital allocator should follow these 4 strategies. First, having proper team structure. And it is recommended to have a team of 3 to 4 members with continuity, cognitive diversity, and high levels of rationality quotient, meaning that these 4 members should have been working with each other for some time so they get a good idea of each other's biases. Having members who think differently while also being more adept to accepting differences in order to benefit the group. And second, capital allocators can also make better decisions by also creating a course of conduct through cognitive safety, which creates an environment where the team members feel safe to share their opinions. That is really important because it's all about following a good process without worrying about the outcome. And that's something I think is very important in decision making in general. As long as you're following a good process and not worrying about the good outcome, over time, with probability, good processes will prevail. Third, independence of thought should be encouraged. And finally, we arrive at behavioral awareness. In order to make good decisions, we need to have that behavioral awareness because our brain has many biases that keep us from making good quality decisions. And to name a few, we've got the confirmation bias, which is a behavioral flaw where we notice or identify things that confirm our existing point of view. And I've definitely fallen for that confirmation bias. The second is motivation reasoning, and this is just confirmation bias on steroids, where we discredit any information that is contradictory to our views. And finally, we've got the tribe identification, where we often only trust ideas or information arising from sources within our tribe or from people we trust. And one of my favorite lines from this book is when the author says that all investors have self-serving bias that wants to take credit when good things happen and defer blame when bad outcomes arise. And that is so true. As humans, we like to take all the credit when good things happen, and hey, it was not our fault when bad things happen, right? That's how we operate. And these are the biases that need to be in check as part of the behavioral awareness when we are making decisions. To further make better decisions, we have to understand that effective decision makers think in terms of probabilities. And we do this by calculating 3 things. Number 1, trying to understand all the possible outcomes. 2, the payoff of each outcome. And 3, the probability of each outcome. We can think of this in investing as investing in stock A versus stock B, what are the possible outcomes, the payoffs of each outcome, and what degree of probability can be assigned to each outcome. Ted also talks about and recommends thinking in base rates, and this was a concept that absolutely blew my mind. And the idea behind this is that instead of having an inside view, for example, when we look at a company's growth rate and expect them to continue growing at this rate, we look at the industry, or we take an outside view where we look at the industry as a whole, or more general understanding of how companies have performed once they've reached a certain size. And that gives us a much better understanding of what's likely to happen for that company over the long term. So outside view instead of inside view when you are making decisions. Now, with any decision-making process, we have to consider the risks. And for this very reason, Ted shares a very neat technique of pre-mortem analysis where we are tricking our brain into believing that the bad has already happened. It is when we tell our brain that the plan has failed, the investment has failed, what happened, what went wrong. Instead of asking what could go wrong, pre-mortem analysis forces us to ask what went wrong as if it's already happened. Playing the devil's advocate, checking our biases, and creating a pro and con list are all risk assessment strategies to minimize our risk as much as possible. Remember, the goal isn't to eliminate risk because we never can do that. The goal is to minimize it the best we can. And now we get to negotiation because let's face it, hedge funds are expensive. Money managers are expensive. And so negotiating is a key skill set needed by capital allocators in order to find the best money managers in the business. And the author shares 2 key tips on negotiating effectively. The first is preparation, which is extremely important in negotiating, and knowing your interest. In other words, what do you want? Why do you want it? And what is your exchange rate? And answering these very simple questions about your counterparty as well. It's going to help you in your negotiating because as much as you know about the situation, the better you're going to be able to negotiate. And we have to remember that in any negotiation, we will rarely walk away with everything that we wanted. So we need to prepare for contingencies and map out all the possible outcomes and all the different paths that the negotiation might take. And we should be open to updating our views. The author also says that we need to continue to seek more information and learn as much as we can about our counterparty. And the more we know, the better we can negotiate. And again, the key part to negotiating is knowing exactly what you and your counterparty want. So learn that by actively listening, noting any distractions that may occur, mirroring our counterparty so we understand exactly what they need, and validating our words, and also certainly being curious during the entire process. Again, curiosity sparks more questions, which leads to more answers, which leads to more information, which leads to better negotiation. So it's a whole process that we can follow to better negotiate. Some additional tips on effective negotiation are knowing your worth, so understanding who has more bargaining power. And this depends on the power dynamics and the demand supply of the money managers, but also focusing on non-monetary items, as there are many benefits of non-monetary items which can yield additional value. Smart trades are also another thing that can be done by giving up things that are of less priority to us, but more to our counterparty. And finally, walking away, which was one of the tips that Ted shares that can actually put pressure on the counterparty and reconsider their offer. And behavioral psychology also suggests that making the first offer benefits from an anchoring standpoint. And remember, a good process can lead to bad outcomes, and bad processes can lead to great outcomes. The thought process is about the process itself and not the outcome. So as long as you have a really good process of making decisions, understanding all the different facets of how a good quality decision is made, eventually over time, you will improve the quality of your decision. The outcomes will also improve. Now we arrive at leadership, which is all about leading by example. And think about it, right? We never follow someone who doesn't do what they preach. We always follow someone who does exactly what they say. And if you wish to become a thoughtful, more effective leader, Ted has 6 tips for you. First is define a purpose. Successful leadership is all about defining a purpose for the entire team, the why behind what we're doing, and getting everyone on board with that same mission and purpose is what makes organizations thrive. Next, we've got setting standards of conduct, so actually leading by examples, and great leaders demonstrate culture through their actions. Now, successful leaders communicate and consistently reiterate their vision and what drives their behavior and personality. Humility and self-awareness are also traits of highly successful leaders, and this self-exploration process enables leaders to be aware of themselves, of the people around them, and their impact on the organization. Next, we arrive at inspire and motivate. Leaders absolutely need to inspire and motivate their team. They need to be the true cheerleaders of their team and also need to motivate their organization through their words and through their actions. And finally, adapt and evolve. Leaders embrace change, so we can't get complacent in an ever-changing world, especially when it comes to finance and investing. So we need to ask questions. What are we doing right? What are we doing wrong? How can we do things better? And by getting feedback from colleagues, peers, customers, leaders can glean into the changing trends and embrace change. Finally, we arrive at management. So if leadership is the vision, management is the implementation of that vision. And without proper management, even a great vision can fail. And Ted shares 5 strategies on how to manage well. And when it comes to hiring, capital allocators need to look for several character traits like smart problem solvers with street smarts and good communicators, both oral and written, team players, and those willing to share what they know. And perhaps the most important is you want people with high integrity. And this reminds me of a quote from Warren Buffett when he says that when we hire people, we look for 3 things: intelligence, initiative, and integrity. And if they don't have the latter, the first 2 will kill you, because if you're going to hire someone without integrity, you want them lazy and dumb. Now with project management, it's all about being able to prioritize, manage, and complete the task at hand. And the author says to prioritize is to articulate. Focus on high priority, urgent, and the low priority, urgent tasks, then identify and articulate which jobs need to get done. And remember, if you assign everyone, you assign no one. So be specific in your delegation and answer the 3 W's, which are who is doing what and when. Next, we have talent development, which is a very critical part of management, and great leaders take the time to develop their people. And finally, time management, which is extremely important at such a high level. So prioritize, articulate, and delegate. Now we arrive at the second part of the book, which is all about developing an investment framework. And remember, this investment framework will teach you how to invest, but not in securities or assets or stocks, but instead in money managers. Because again, we're talking about capital allocators. First, we have the governance. And as Carl Sheeter said, quote, "You can't have an investment success with bad governance." Now, every fund or endowment works differently, but the capital allocator doesn't usually have full autonomy over the money managers or the capital or any other important decisions. Most important decisions are deferred to the board of directors, and they're the ones who create and set the foundation for the governing structure of the fund itself. The governing structure and the board of directors basically have the power to make or break the deal with money managers. It's possible that a capital allocator loves a money manager and their track record recommends them to the board and they get shot down. So in order to have a sound governance, Ted shares that a clear delegation of responsibilities and roles is needed so that there are no blurry lines or to avoid confusion. And roles and responsibilities should be specific to help govern the fund. And the 3 C's make up the governing bodies. These are composition, conduct, and communication. Composition is all about who sits on the board to begin with. Conduct is about how these meetings and other initiatives are carried out. And communication is how often and how flexible the communication will be. The author also shares that effective governance may be the most important and the least understood part of investment returns. And now we get to investment strategy. Now, investment strategy is all around managing expectations. We have to understand that the purpose of institutional investors is not to catch a huge move on AMC stock, but it is to manage intergenerational wealth. We're talking long-term focus. And when I say long-term, I don't just mean 10 or 20 years. We're talking beyond long-term, several hundreds of years, because we have to understand that institutional pools of capital worth hundreds of billions of dollars will most likely outlast any CIO, capital allocator, or money manager for that fact. Now, because investing is such an emotional endeavor, and even though the time horizons are long-term, we're talking several decades, board of directors still start to get very angsty even after a year of underperformance. And they start to look for alternatives in year 2 of underperformance and fully move over to the next money manager in year 3. And finally, once through proper due diligence and understanding of time horizons, money managers are finally appointed as part of their institutional investing strategy. And capital allocators create what's called a policy portfolio of managers focusing on different markets with different expertise and skills. For example, if an institution has $10 billion to invest, they could decide to allocate $1 billion among 3 different money managers focusing on international equities, another $2 billion between 5 money managers focusing on US real estate, or maybe another $5 billion to 10 different portfolio managers focusing on investing in US equities, and so on and on. The composition of these money managers is called, quote, team structure, which can consist of both internal and external managers, from generalist to industry specialist and analyst, and people from all different walks of life to offer different perspective. Now, capital allocators also have many ways to source new money managers, and every money manager perhaps has only one question in their mind: what is it that capital allocators are really looking for in a money manager? And the sad news is that there is no one generic response to this question, because all allocators need different things. They have different goals, different governance structures, different demands of the boards that they serve, different time horizons, different risk tolerance. So you could be a hotshot money manager with a solid track record, but if you don't fit the description of what the allocator or the board is looking for, well, tough luck. But in general, there are soft skills and traits this book shares that money managers can increase their chances of getting hired. And these are the 3 A's, which include approach to the market and life, your competitive advantage, which is meaning your edge, and your alignment with the CIO and the board. The 3 P's, which includes people, process, and performance, people in your organization, the process from start to finish on your investment ideas, and of course your performance. And the 5 T's, which includes your talent, trending, tracking error, tails, and tolls. But perhaps the most important trait that Ted shares in the book is character. And a couple quotes that I want to read that are super interesting were that a past performance is not indicative of future results, except when it comes to character. And that, in my opinion, was an amazing quote. Now, finally, we get down to the portfolio construction, which happens through learning about money managers, rebalancing their allocation, and constantly monitoring their performance. Speaking of performance, technological innovation has also made it a lot easier for capital allocators to track and measure the performance of their money managers. And the book talks about how there are many data analytics softwares that allow you and give you the tools for both risk measurement and risk management. Now, risk measurement is simply exploring risk exposures by managers to calculate the market risk across different asset classes, different ownerships, the duration, liquidity risk, and ESG. And risk management is simply taking action on that measured risk and making changes to the portfolio if necessary. Without downside risk, there is no return. So we have to understand that risk management is not about eliminating all the risk altogether, but trying to attempt to lower the probability as much as possible. So there you go. That was the entire process on how to get yourself a hotshot money manager with a solid track record if you are a large institutional investor or a capital allocator. The third section of the book was filled with some very insightful quotes from the guests. Now, that part of the book did feel like a strategy to fill a lot of the pages because the book is only 185 pages and 40 of those pages are filled with a lot of quotes from the podcast guests. But that being said, here are some of my favorite quotes. Michael Novergat says, "Great bubbles happen around great stories." Dan Ramusan says, "In times of easy money, a lot of stupid things work. A lot of unprofitable companies see massive increases in stock price, and a lot of bad ideas get funded, and some of those bad ideas actually turn out to be good ideas." Adam Blitz says, "Very few of our best investment ideas have had every single box checked absolutely perfectly. In fact, some of our more mediocre investments had initially checked off every box. Brian Portnoy says the paradox of choice profoundly states that humans are wired to want more choice and opportunity, but the more choice they get, the more miserable they become. Larry Kochart says if you are managing someone else's money, there's a level of either absolute or relative loss that you can't go beyond and still continue to sit in the seat. And Andy Golden once again says being a contrarian means you have to do some very uncomfortable things. Tom Russo says the manager of portfolios and the owner of a business need the capacity to suffer. And here's a good one on overtrading and market decisions from John Waltham. Don't just do something, stand there. And that is such a powerful quote because oftentimes we tell people, don't just stand there, do something. But in the markets, the fewer decisions we make, the better those decisions are. And that's why don't just do something, stand there. So there you have it. That is Capital Allocators by Ted Seides, the entire summary. Let me know your thoughts down in the comment section below. And what do you think about this book? As always, happy investing. I'll see you all in the next video.